studying your last two. I swim med tid when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Let's now look at how dividend income flows through professional tax software. In this example, instead of earning interest income or rental income, the corporation receives a $10,000 dividend from another corporation. Imagine that corporation has already earned business profits and decides to distribute part of those profits as a dividend. Corporation B, which owns shares in Corporation A, receives a dividend of $10,000. From the tax preparer's perspective, the process begins just like any other type of income. The dividend income is entered into the corporate tax software by recording the amount received. In this example, the tax preparer enters $10,000 as corporate dividend income. Once the information has been entered, the software begins processing the data automatically. However, this is where dividend income becomes different from interest income. When the software recognizes that the income is a corporate dividend, it does not apply the same tax rules used for interest income or rental income. Instead, it automatically switches to the special tax rules that apply specifically to dividends received from another corporation. This is an important distinction. Although both interest income and dividend income are forms of investment income, they follow different paths through the corporate tax system. The software identifies the type of income first and then applies the appropriate provisions of the Income Tax Act. At this stage, you don't need to worry about calculating Part 4 tax or determining whether the dividend came from a connected corporation or a portfolio investment. Those calculations happen automatically after the software analyzes the details of the dividend. The important concept is simply this: the tax preparer enters the dividend income accurately. The software recognizes that it is corporate dividend income. Then, instead of using the ordinary investment income rules, it automatically applies the specialized corporate dividend tax rules. This is why professional tax software is so valuable. It not only performs the calculations, but also determines which set of tax rules applies based on the type of income that has been entered. In the next slide, we'll look behind the scenes and watch the software determine whether Part 4 tax applies to this $10,000 dividend. You'll see how the software analyzes the dividend, applies the correct rules, and begins building the corporation's refundable tax accounts automatically. Now let's look at what happens inside the tax software after the corporation receives $10,000 of dividend income. Unlike interest income, dividend income requires an additional analysis. The software cannot simply calculate tax immediately. First, it must determine what type of dividend the corporation has received. The software begins by identifying the income as a corporate dividend. It then checks the relationship between the corporation receiving the dividend and the corporation paying it. One important question is asked: did the dividend come from a connected corporation, or is it a portfolio dividend from an unrelated corporation? This distinction is important because different tax rules may apply depending on the type of dividend received. Once the software has identified the correct category, it automatically determines whether Part 4 tax applies. Part 4 tax is a special corporate tax that applies to certain dividends received by corporations. Its purpose is to support Canada's tax integration system by preventing corporate dividend income from escaping tax completely, while still allowing the tax to be recovered later under the appropriate circumstances. The important point is that you do not manually calculate Part 4 tax during normal tax preparation. Professional tax software performs this calculation automatically. It analyzes the dividend, applies the legislative rules, determines whether Part 4 tax is required, and calculates the appropriate amount. If Part 4 tax applies, the software doesn't simply treat it as ordinary corporate tax. Instead, The amount is recorded in the corporation's Refundable Dividend Tax on Hand, or RDTOH, account. This means that the tax becomes part of the corporation's refundable tax balance and may later be recovered when the corporation pays taxable dividends to its own shareholders. So, although Part 4 tax is initially paid, it is generally not intended to be a permanent tax. It becomes part of the refundable tax system that we've already studied. A simple way to remember this process is dividend income is entered into the software. The software identifies the type of dividend. It determines whether Part 4 tax applies. If applicable, the Part 4 tax is added to the corporation's RDTOH account. As a tax preparer, you don't need to memorize every legislative rule behind Part 4 tax. Instead, your goal is to understand why the software is calculating it and where the amount goes afterward. In the next slide, we'll follow these numbers one step further and see how Part 4 tax flows through the software into the corporation's refundable tax accounts and eventually becomes part of the future dividend refund process. Let's complete the journey of our $10,000 corporate dividend and see how Part 4 tax flows through the tax software and eventually becomes part of the corporation's refundable tax system. The process begins when the corporation receives $10,000 of dividend income from another corporation. After the dividend is entered into the tax software, the software identifies it as corporate dividend income and applies the appropriate tax rules. If the dividend is one for which Part 4 tax applies, the software automatically calculates that amount. The tax preparer doesn't perform this calculation manually. Instead, the software analyzes the dividend, applies the legislative rules, and determines the correct amount of Part 4 tax. Once calculated, the Part 4 tax becomes part of the corporation's tax results for the year. But here's the important point. Unlike many other corporate taxes, Part 4 tax is generally refundable. Instead of simply being paid and forgotten, the amount is added to the corporation's Refundable Dividend Tax on Hand, or RDTOH, account. Think of the RDTOH account as a storage account for refundable tax. Every time refundable tax, such as Part 4 tax, is created, the balance in this account increases. At this stage, no refund has been received yet. The refundable tax simply remains in the RDTOH account, waiting for the next important event. That event occurs when the corporation decides to pay taxable dividends to its own shareholders. Once those dividends are paid, the corporation may qualify for a dividend refund from the Canada Revenue Agency. The refund is funded from the refundable tax that has accumulated in the RDTOH account, including amounts such as Part 4 tax. This process is a key part of Canada's tax integration system. The objective is not to permanently tax the same corporate profits multiple times as they move from one corporation to another and eventually to individual shareholders. Instead, the system temporarily collects refundable tax and later returns it when corporate profits continue flowing through the dividend system. As a tax preparer, there are 4 things you should always review when dealing with corporate dividend income. First, confirm the type of dividend that was received. Second, review whether the software has calculated Part 4 tax. Third, verify that the RDTOH account has been updated correctly. And finally, understand that today's Part 4 tax may become tomorrow's dividend refund when the corporation pays dividends to its shareholders. The key takeaway is simple. Dividend income enters the tax software. The software determines whether Part 4 tax applies. If it does, the amount is added to the corporation's RDTOH account. Later, when taxable dividends are paid to shareholders, that refundable tax may be recovered through the dividend refund system. Understanding this complete flow helps you see that Part 4 tax is not an isolated calculation. It is an important link in Canada's corporate tax integration system. connecting corporate dividend income, refundable tax accounts, and future dividend refunds into one continuous process.